Welcome to Alpha Recap. I'm Morgan. Thanks for joining our post-market breakdown. Today we dug into a lot of action from Friday. And as always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Lots to unpack from the session. Rates, microcaps, and some pretty dramatic flows into bearish products.
Let's hit the top line first. Markets closed mixed on Friday, driven by a hotter-than-expected inflation print that pushed yields up and then rippled through a bunch of pockets in the market.
Right. The consumer price index came in hotter than consensus, about 3.8% year over year, and that nudged the 10-year Treasury yield up to roughly 4.4% by the close.
So, what really stands out here is the chain reaction. Higher inflation, higher yields, and then repricing across sectors. Walk us through the mechanics. Why did advisory and transaction-oriented names feel the pressure?
Analysts note that when yields rise, the present value of future fees and deal-related revenue comes down. Boutique advisory firms that get a lot of income from mergers and IPO activity are sensitive to that. You saw one such firm slip about 4.5% intraday, consistent with that sensitivity.
So higher rates essentially make future revenue streams less valuable today, which is a hit for fee-based, transaction-orientated businesses. Simple but powerful dynamic.
Exactly. And then there was a second, very visible theme. Liquidity-driven volatility in tiny cap names and huge flows into inverse and leveraged products.
Let's pause there, because this part was loud. Two things. First, a lot of headline moves in penny and microcap stocks. Second, big volume in ETFs that aim to deliver magnified, bearish exposure.
Yeah, not a great day for thinly traded names. One small company, trading under $1, plunged about 51% to roughly 95 cents on nearly 9.6 million shares. Another tiny issuer dropped nearly 49% to essentially zero at the reported close. Those moves are eye-popping, but they often reflect illiquidity more than fresh fundamentals.
Right. Percentage moves at those price levels can be misleading. A couple of large trades or a pullback by market makers can create enormous percent swings even when the dollar value is small.
Analysts emphasize you need to pair percent moves with nominal volume and context. Some other microcaps actually shot up. One gained about 76%, another about 82%. Again, on very low nominal prices and thin volume. Those are classic microstructure stories.
And the flip side was those leveraged bearish products. We saw an inverse small cap fund jump about 7% on very heavy volume, roughly 330 million shares traded. And a semiconductor-focused inverse 3x product rallied about 12% to around $9.26.
Those moves underline how leveraged ETFs amplify short-term sentiment. Analysts keep pointing out these funds reset daily, so they're path-dependent. Great for tactical plays. Risky if you hold them through multi-day swings.
So let me be clear. Those vehicles can be useful for intraday or very short-term hedging. But because of compounding and volatility drag, their multi-day returns may diverge a lot from the underlying index multiple, right?
Right. And the heavy volume suggests a lot of tactical activity, either hedging or short-term positioning, not buy and hold usage. The structure creates both opportunity and potential for surprise.
Switching gears, there were also corporate and headline items that added to the noise. Pershing Square disclosed a new position in Microsoft, and media commentary about a potential high-profile IPO stirred debate. Give us the take on those.
Pershing Square's filing showed entries of about 1.6% and about 0.8% in Microsoft across filings, which analysts parsed in different ways. Some thought the larger figure could signal an activist tilt. Others cautioned the filings may reflect different reporting thresholds or aggregated vehicle holdings, so intent wasn't crystal clear.
And then there was the SpaceX chatter. Jim Cramer warned a hyped, limited-supply IPO could be destabilizing. Analysts disagree. Some see contagion risk through speculative flows. Others think a controlled allocation just concentrates demand. Interesting debate.
I mean, when you step back and look at this, the key question is whether a hot, tightly allocated listing pulls speculative capital away from other names and creates spillover volatility. It could, or it could be contained. The disagreement is mainly about scale and where the demand comes from.
Quick reactions, short takes. Markets closed mixed, big CPI surprise, liquidity blowups in microcaps, heavy flows into inverse funds.
Yep, and to add to that, watch the filings and the volume, not just the percent moves.
Let's dig into why microstructure matters, because that's a place where a lot of retail listeners get tripped up.
When a stock trades at fractions of a dollar, bid-ask spreads tend to be wide. Odd lot trades matter more, and a single large block can swing the reported last trade dramatically. Analysts warn that those percentage changes often reflect noise and execution risk, rather than a new signal about the company's long-term value.
Yeah, so the storytelling here is, for tiny names, always check dollar volume, look for trading halts, recent filings, and who the market makers are. That context changes everything.
Exactly. And this is where regulatory filings and market maker behavior can be more informative than headline percent moves.
Okay, practical implications. Analysts sketched out guidance by investor type. Walk us through the different lenses.
Long-term, fundamentally oriented investors were reminded not to overreact to a single session. Analysts suggested watching earnings revisions, free cash flow, and capital allocation versus one-day price action. Active traders and momentum players saw opportunities, but faced elevated execution risk, especially in leveraged products and microcaps. Risk managers got a reminder that higher yields increase hedging costs and raise gap risk, particularly over holiday weekends. Credit and income investors saw better nominal yields, but also higher refinancing pressure for fragile balance sheets. And activists or event-driven investors were put on alert to parse filings carefully before drawing conclusions.
That's a helpful taxonomy. A lot depends on time horizon and execution capability.
Yeah, that tracks.
A couple more specifics that analysts flagged. First, CPI to yields to advisory revenue. The link was front and center. Second, leveraged ETF mechanics matter over time. Third, penny stock dynamics meant some moves were probably microstructure noise.
And to add to that, the Pershing Square filing reshuffled expectations for a major software company, which could introduce activist dynamics. Not necessarily immediate, but something to watch in subsequent filings and public comments.
Before we wrap, give listeners 3 clear takeaways from Friday's session.
1. Analysts agreed the CPI surprise and the rise in the 10-year yield were the dominant macro drivers, and that explained much of the rotation into defensiveness. 2. Liquidity and microstructure amplified moves in tiny names, so percentage changes in penny stocks often need to be taken with a big grain of salt. 3. Leveraged and inverse products saw huge tactical flows. They amplify short-term sentiment and aren't generally suitable for long-term passive exposure because of path dependency and volatility decay.
Nice! And a couple of closing practical notes. Monitor rates and any CPI-related follow-ups, watch position filings for big-name catalysts, and treat leveraged ETFs as tactical tools with clearly defined time horizons.
Honestly, I was a bit surprised by how much volume flowed into those inverse products in a single day. It underscored how quickly sentiment can shift when rates reprice.
Yeah, absolutely. Quick reactions, 2 final micro comments.
Watch weekend headlines. Gaps can appear when markets reopen.
And keep an eye on filings and market maker behavior in tiny names.
If you want the full write-up and source links, we summarized the analyst notes and trade flow data on the site.
All right, that's a wrap. For clear takeaways, higher inflation drove yields up. That pressured advisory and growth-sensitive names. Microcap moves were dominated by liquidity dynamics, and leveraged inverse funds saw heavy tactical flows. None of this is investment advice. Analysts' views are informational and not recommendations.
Thanks for listening. If you want to dig deeper into any of these points, we're happy to follow up.
If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. See you next session.